The trading day is drawing to a close, and the last reported intraday price for SoFi Technologies, Inc., trading under the Nasdaq ticker SOFI, stands at $28.76, reflecting a positive movement of 43 cents or 1.52% for the session. The chart shows a classic afternoon drift after an earlier morning peak around the $29 level, which is a key technical ceiling that the stock has struggled to break cleanly through and hold over the past few weeks, a struggle that defines the current expectation versus reality dynamic for this name. The market's expectation for SoFi is clearly high. Investors, particularly the retail crowd, view it as the future of finance, a one-stop digital banking shop with a technology infrastructure that gives it an unfair advantage over legacy banks. The reality, however, is a stock that has become fundamentally range-bound between the $26 floor and the $30 to $32 ceiling, unable to make a sustained upward breakout despite repeatedly delivering stellar growth numbers and, crucially, its first quarter of GAAP net income in Q3. This inability to launch higher, even on good news, creates the tension. The insight you might not anticipate from that modest 1.52% gain is that it follows a relatively high-volume session of institutional accumulation, hidden slightly beneath the surface of the price action. We've seen a measurable uptick in large block trades throughout the late morning, suggesting that while retail traders are debating the short-term resistance, deeper-pocketed institutions are quietly adding to their positions. The last institutional filings indicated significant additions from giants like JP Morgan and BlackRock in the most recent quarter, with the latter adding over 13 million shares and the former an astonishing 42 million shares. This is the smart money effectively voting on the long-term bank charter story, a vote that contradicts the prevailing skepticism and the short-term noise that keeps the stock from running. The common belief is that SoFi is still too much of a high-growth, high-multiple stock, trading at an aggressive P/E ratio over 52, especially when compared to its peers in the financial services sector. The deeper truth is that these institutions are not valuing it as a traditional bank at all, but as a technology platform leveraged into banking. Their bet is on Galileo and Technisys, the B2B tech platforms that power other fintechs and banks, providing a much higher margin, more scalable business model than the personal lending and student loan refinancing business that first put SoFi on the map. This core business model diversification is what the market is mispricing and why the stock appears relatively cheap to those institutions who understand the platform-as-a-service potential. Drilling down into the daily movement, today's price action was characterized by tight swings. Opening near $28.71, the stock immediately pushed to its high of $29.15 before pulling back. High to low for the day was relatively contained, with the floor at $28.31. This low volatility for a growth stock, especially compared to its historical swings, suggests that the market is attempting to find a new equilibrium, a price point that fairly balances the impressive Q3 results, which featured record net revenue of $962 million and a net income of $139 million, against the broader macroeconomic headwinds of persistent high interest rates. High rates are a double-edged sword for SoFi. They increase the profitability of their bank-side operations, maximizing the net interest margin on their deposits and loans. But they also cool the demand for their core lending products, particularly student loan refinancing, a segment where higher rates make the arbitrage less attractive to consumers. The net result is a stalemate in the stock price, even with strong operational performance. It is a classic tension where flawless execution is meeting an uncooperative capital market environment, leading to a frustrating sideways consolidation for long-term holders. Now let's address the short-selling awareness and the reality of the pressure on SoFi. This stock is and has been a magnet for short sellers. The latest reported short interest shows over 110 million shares sold short, representing about 9.3% of the float. While this isn't an astronomical figure when compared to heavily meme-traded names, it is notably higher than the peer average for its sector, which sits closer to 8.7%. The days-to-cover ratio is relatively low at around 1.5, meaning it would take slightly more than a day and a half of average trading volume for shorts to cover their positions, which limits the potential for a massive sudden short squeeze. However, the short thesis, primarily espoused by traditional financial analysts and contrarian funds, centers on two main points: the valuation disconnect and loan quality. They argue the bank is fundamentally a lender, whose loan book is exposed to economic downturns, and the tech platform story is not worth the premium multiple, especially when the cost of capital for all financial institutions remains elevated. Retail sentiment, frequently expressed on platforms like Reddit, focuses on the high number of off-exchange short volume, sometimes accounting for over 30% of total volume, which fuels theories of coordinated suppression. The actionable insight here is for investors to monitor the short borrow fee rate. While it remains low at around 0.25% annually, a significant and sustained spike in this rate would signal increased demand for shares to short, which could precede further downside pressure, or conversely, act as a trigger for a potential short squeeze if a substantial positive catalyst hits. You should always check the FINRA and exchange reported data for short interest updates bi-monthly. Do you think the high institutional accumulation by firms like JP Morgan and BlackRock will eventually overwhelm the short seller pressure, or are the short sellers right to focus on the high PE ratio in this rate environment? Comment below with your take on this expectation versus reality trade-off. The foundation of the SoFi story rests on its three segments: lending, technology platform, and financial services. The lending segment remains the primary revenue engine, fueled by personal loans, student loans, and home loans. The key shift here is the mix, moving aggressively toward high-quality personal loans, which have better margins and are less sensitive to government policy than student loan refinancing. The second segment, the technology platform, which includes Galileo and Technisys, is the long-term growth driver, offering banking as a service to a wide range of companies. This segment's growth is what legitimizes the high PE multiple and its status as a growth technology stock rather than a commodity bank stock. Finally, the financial services segment, which includes SoFi Money, SoFi Invest, and SoFi Credit Card, is the sticky, high-engagement part of the ecosystem, designed to acquire members cheaply and then cross-sell them into the higher-margin lending products. Recent news, like the launch of in-app crypto trading for consumers and a partnership with financial specialist Vivian 2, aims to deepen that member engagement and bring new users into the ecosystem. The entire architecture is built around the financial services supermarket concept, aiming to capture the entire financial life of its high-earning but not yet wealthy customer demographic. The shift to a national bank charter earlier this year significantly reduced the company's cost of capital, allowing it to hold loans on its balance sheet rather than sell them to third parties, which is what fundamentally powered the Q3 net income profitability. Looking ahead, the future outlook for SoFi is intrinsically linked to two primary catalysts. The first is a sustained period of GAAP profitability, which is a non-negotiable step for institutional inclusion in indexes and broader acceptance by conservative funds. While Q3 was positive, the market will be looking for multiple quarters of sequential profitability to confirm the business model is scalable and resilient. The second is the continued aggressive growth of the technology platform. If Galileo can secure a few more large marquee clients in the coming year, it will fundamentally reset the narrative around the company's value, proving that the technology segment is a major profit center in its own right, not just a small component of a larger lending business. The main risk, apart from general macroeconomic turbulence, is execution risk in the loan book quality. As SoFi expands its member base and lending portfolio, any significant deterioration in loan performance could quickly unravel the hard-won bank charter advantages and profitability gains. The options market is currently reflecting this tension, with high call option volume near the $30 and $35 strike prices, suggesting an expectation for a near-term rally, but also significant put-open interest, indicating institutional hedging against downside risk. This all points to an environment where the stock is tightly coiled, awaiting a decisive directional signal. In summary, the expectation for SoFi is an immediate breakout to former highs, fueled by its proven capacity for sustained